So our plan tonight, he's gonna talk a little bit about the Federal Reserve Bank. What is it, priorities, and then we're gonna maybe ask a question and then open it up for question and answer. Does that sound good?
That sounds great. So first of all, thank you very much.
Sure.
And I see a few people standing in the back. There are 3 seats right here,
right in
or there's
front.
some seats there on the side if you don't want to stand the whole time. Thank you all for being here, and thanks for helping organize this. I always like to start by talking about why am I here, and why is there a Federal Reserve Bank in Minneapolis, and what do we do? Because most people don't know, and I didn't know that before I went to Washington, D.C. So if you go back in our nation's history, so the Federal Reserve is our nation's central bank. And if you go back in our nation's history, is that roped off? Is that my fault because that's roped off for the camera? Well, it's all right, you'll be fine. The camera will adjust. Thanks for being bold. If you go back in our nation's history, our nation always hated the idea of having a central bank. And the reason is because it sounded mysterious. A bunch of bankers in a dark room doing God knows what for God knows what reason. Alexander Hamilton created our first central bank. It lasted about 20 years, and then Congress and the president said, enough of that, we don't like it. Well, then in the 1800s, our economy kept getting hammered with banking panics and financial crises. There was a really big one, the Panic of 1907. And then Congress said, well, geez, we don't like having a central bank, but I guess we need one to manage these crises so we don't have so many crises. But if we're going to have one, we don't want all this power concentrated in Washington, D.C. or New York. So they came up with a compromise. They said, if we have to have a central bank, let's have it distributed around the country. So they created this, what we call a federated system, where we have the Board of Governors of the Federal Reserve. You've probably heard of Janet Yellen. She's the chair of the board. And before her was Ben Bernanke. And before him was Alan Greenspan. I bet you heard of Alan Greenspan. He and the board, and Janet now and the board, are appointed by the President of the United States. And then there are 12 regional Federal Reserve banks, including in Minneapolis. And the president of those reserve banks are appointed by a local board of directors. And this was Congress's idea to say, let's have a central bank, but we don't want all the power concentrated in Washington, D.C. So my job, the reason that I'm here, a big part of my job is to get out across our region, all the areas you just mentioned, to get to know what's happening in the local economy, so that when I go back to Washington, D.C. 8 times a year, and we set monetary policy for our nation, I'm able to bring to that discussion, here's what's happening in our region, what we call the 9th Federal Reserve District. So that's why I'm here, and that's why it's so important that I hear directly from you. How's it going? What are the challenges you're facing? What's the job market like? What's happening to wages? These are all really important inputs for us that I then take back to Washington, D.C. So at the Minneapolis Fed, we have about 1,000 employees. We do a number of different things. We regulate banks. We do economic analysis and forecasting. We do outreach into the communities. We have a center of researchers focusing on Indian country, trying to bring economic development to Indian country. We have our own law enforcement division because we have a giant vault. And when you see Brinks trucks coming to and from your bank, there's a good chance they're coming and getting cash from us or bringing old cash back to us, that we have machines that sort and that shreds the old money and then brings new money into circulation. So all these different services we provide to our local economy and to our financial sector as well. So thank you for being here. Sorry for the long overview, but most people don't have that background, so I think it's good to level set.
I think that's great. So monetary policy, why don't you explain your role with monetary policy and how you interact with fiscal policy, perhaps?
Sure. So there's a very big distinction between monetary policy and fiscal policy. So fiscal policy is when your tax dollars, you pay your taxes, the U.S. Treasury Department collects those taxes, and then the Congress decides what the federal government's going to spend on. That's fiscal policy. That spending could be defense, it could be education, it could be healthcare, it could be any number of things. But this is the debate. So the President of the United States introduced his budget today or yesterday, and Congress is going to look at that budget. They're going to decide what they want to spend on. They're going to enact what they want, and then the President has to sign that into law. So that's fiscal policy. That's not our role. There's a big separation. Our role is trying to use interest rates, what we call monetary policy, to adjust the ebbs and flows of the economy. So if the economy is overheating, the Federal Reserve will tend to raise interest rates to cool it down so it doesn't get too hot and then run into some kind of trouble. Or if the economy is growing way too slowly, the Federal Reserve will cut interest rates to try to boost economic growth. And the way that works is this. Let's say if interest rates are lower and you want to buy a house, your mortgage is going to be cheaper, so you're going to be able to afford more house. That's a way of stimulating your own activity. Or if you have a business and you want to expand that business, if you can get a loan and that loan is cheaper, it's easier for you to expand that business. That's how credit leads to either more economic growth or less economic growth. So we can affect that by raising and lowering interest rates as a way to try to manage the economy from getting too hot or too cold.
Mm-hmm. And I'm going to ask one more question and then we'll kind of open it up because this is really about all of you too. But I'm curious, and I know a lot of people are curious, so why did you choose the Chequamegon Bay to visit our community?
Well, my goal is I want to get out into every state in our region every year, at least once. And whenever I go back, I want to visit a new part of the state that I haven't been to before. So I've never been here. And so this is an important part of the state. It's the important part of my district. And importantly, I've never been here before. So it's a great way for me to come here and learn. And hopefully it's not my last visit. I plan on coming back. But
well,
I figured,
we hope so.
And well, I got to tell you this is a great turnout. So this is a very warm welcome for me, which I very much appreciate. And that makes me want to come back. So thank you already for the beginning of the discussion.
And welcome to the Chequamegon Bay, 33,000 acres of great Lake Superior, and find yourself next to the water in Ashland, Bayfield, the gateway to the Apostle Islands. So enough of that. So do we have questions out there? Should we start the question here?
Anything at all you'd like to
Ron
talk about?
has a mic and Jean has a mic. Anybody want
Up
to
here in
start?
the front.
Okay.
Lady here in the front. To your right.
Yeah, I was just wondering if you could discuss the unemployment rate, the current level, and then how that affects maybe and what you see with underemployment.
Sure. So the headline rate nationally right now is around 4.4%. And over time, over the last several decades, usually the headline unemployment rate is a pretty good measure of how the overall job market is doing. But the headline unemployment rate only includes people that are looking for jobs, actively in the labor force. So if you think about this, somebody who's retired is not considered unemployed because they're not in the labor force, they're not looking. But after the Great Recession and the terrible recession that we had in 2008, 2009, 2010, this picture got a lot more murky. And it ended up a lot of people who otherwise would want to work, so not retired folks, gave up looking because they just couldn't find a job at all. So it's really curious because then they're not captured as unemployed, yet we kind of know they would like to have a job. So we look at a lot of different measures besides just that headline unemployment rate to try to get a sense of how is the job market doing. So we have other measures of counting the people who've said, hey, I've given up looking. I'm not in the labor force. I'm not in the market, but I would like to have a job if I could get one. We also look at people who have part-time jobs, but who say, I would like to have a full-time job if I could get one. And we look at measures like the percentage of the population as a whole that are simply working or not. And we know that that's trending down because our society is aging, more people are retiring, so that's not a static measure. And then we also look at wages. Are wages growing? You know, you would expect if the unemployment rate is very low and people can't find workers, businesses will be competing with each other for the workers. That'll push wages up. So we're seeing some wage growth, but it's not rapid wage growth and it's not yet at a concerning level in any sense. So it's a very complicated picture. It seems like the job market nationally is getting stronger. There are some signs that we're reaching what economists call full employment. But if you look beneath the surface, there are still some signs of slack. And very importantly, wages have not grown very fast at all. And so it's possible that wages will keep growing from here. Did I answer your question?
Yeah. And do you know anything about like what's our Minneapolis, what's our area, what's going on?
Yeah, I mean, I do. The woman, not into the mic, the woman asked about the region as a whole. The region as a whole is doing, it's mixed. Like some parts of the region are doing better than others. The Minneapolis region, the Twin Cities, are doing very well. The unemployment rate is very low. Our region of the country has a very diverse economy. So we have natural resources, we have agriculture, we have manufacturing, we have services, we have healthcare, et cetera. Most major sectors of the U.S. economy are represented in our region broadly. So that's a source of strength, that diversity, because some sectors might do well and others are doing less well. So that balances out. But obviously, if you're in one of those regions that's not doing as well, that's tougher. And so I don't think that this corner of our region is doing as well as the Twin Cities is. But it's certainly, by the data, it's gotten better over the last few years. But that's what I'm here to learn from you. I want to hear firsthand how it's going. Go ahead, Gene. Oh.
I would like to follow up on this woman's question a little bit. You mentioned some of the measurements in determining the unemployment rate, and an unemployment rate of around 4 or 5%, well, 4.5%, 5%. That sounds like a very strong economy. In the measurements, do you also look at gender, at race, at poverty? Now, you think of a person who's working part-time, $9 an hour, less than 40 hours a week because the employer either doesn't want to or can't provide the benefits that a 40-hour week employee. Do you look at that? And I think maybe you've got a different opinion on that because you were the only person on the committee who voted against raising the rate in March.
Correct.
So would you go into a little more depth about maybe other measurements have to be considered in greater importance than they currently are considered in determining the national unemployment rate?
Yeah, thank you for your question, sir. So you're right. We do, and this is somewhat of a shift for the Federal Reserve. Historically, monetary policy is what we call a very blunt instrument. That means if we have to look at the national statistics and then we raise one interest rate for the whole country. Right? We can't target it to Wisconsin or Minneapolis or Detroit. When we raise interest rate, it raises interest rates for everyone, or we cut interest rates, it cuts interest rates for everyone. So historically, the Federal Reserve has said, well, we're just really going to look at the averages. We're not going to look that deep beneath the surface at different communities. That's starting to change. And we as a system, and I personally, but we as a system are looking at some of those other measures. So I'll give you an example that I find striking. In America today, African American unemployment is roughly twice white unemployment nationally. But the darndest thing is that whether it's a recession or a booming economy, that's always true. And when you compare college graduates against college graduates, it's also 2 to 1. Or if you compare high school dropouts against high school dropouts, it's also 2 to 1. So if you slice it up by race, if you slice it up by education achievement, you get a very different picture than if you just look at the headline measures. So we do look at these other measures to get a sense of who's falling behind in the economy. Is it, typically highly educated people, they don't suffer that much in recessions. It's the lower skilled workers who are the first to lose their jobs, and they end up suffering the most. So we absolutely do look at these things. And in fact, in Minneapolis, we just launched a major new research initiative focusing on understanding these factors, on what leads to these different employment outcomes, and what can policymakers do about it. And so we are looking at it. It is very important, and I'm glad you raised it. Hi.
So you have these 12 different districts. How exactly do you guys determine what the end policy is going to be nationally?
Well, we meet 8 times a year in Washington, D.C., and we end up having a vote on what we're going to do for interest rate policy. So, and the way it works, and this is what Congress created literally in 1913, is you have the governors in Washington, D.C. that are appointed by the president. There's up to 7 of them, and then there's 12 presidents. And the presidents rotate on who's voting. So I'm a voter this year, but I won't then be a voter next year or the year after that, and then I will be voting again the year after that. So this year I'm voting, so all 17 of us, or 16 of us right now, not all the seats are filled, are there at every meeting, and at every meeting I report what's happening in our region, in our local economy. I report my assessment of the national economy, and then I give my recommendation on what I think we should do. And then at the end of the 2-day meeting, we then take a vote. And then the votes are cast. And as the gentleman pointed out, in March, there were 10 people who were eligible to vote, and 9 people voted to raise interest rates, and I was the one person who voted against it. And the reason I voted against it was I still saw slack in the labor market. There's still some unemployment that I think could be sopped up. And the other goal that we have is for stable inflation. We were coming up a little bit low on that front too. So Congress has given us what we call a dual mandate. That means stable prices and maximum employment. And we try to look at both of those measures to see how we're doing when we make our interest rate decisions. So it's a very democratic process in that we have a set voting pattern. People rotate who gets to vote. We cast the vote, and then the vote carries the day.
Besides, just a question on interest rates, besides national trends, labor, employment that you talked about, isn't there some pressure to raise rates just for the Fed's own balance sheet to start relieving some of that? That's a consideration at some point because interest rates have been so historically low that that's a pressure point as well?
Sure. So the Fed's balance sheet, let me spend a minute and talk about that. When we had the terrible economic crisis in 08 and 09, the Fed cut interest rates to zero, or close to zero, 0 to 25.25%, as low as we could go. But then the question was, is that all we could do? Because the economy was still just barely grinding along. And again, you think about the mechanism by which interest rates affect economic growth, it's about your cost of borrowing. So if we can lower your cost to borrow to buy a house or to fund an expansion in your business, that makes it easier for you to help grow the economy. So the other way the Fed did, once we got interest rates effectively down to zero, the Fed started buying long-term treasuries and mortgage-backed securities as a way of driving down long-term interest rates. In doing so, the Fed accumulated this big balance sheet. It's around $4.5 trillion. Typically, it was less than $1 trillion before. So now we have all of these assets, and the assets are Fannie and Freddie mortgage-backed securities and U.S. Treasury bonds. And the question that the gentleman's asking about is, isn't there pressure to start to shrink that balance sheet over time? And the answer is, there's not pressure to do so, but we would like to do so. We would like to shrink it back down to more of a normal size. And actually, just today, the Federal Reserve announced some ideas that we're looking at on how to do that. The basic idea is, if you buy a bond from the U.S. Treasury Department, let's say you buy a 10-year bond. 10 years after you buy the bond will mature, and you're going to get a check from the Treasury Department for your principal amount that you invested. Well, that's the same thing that's going to happen to us. As these bonds mature, we're going to get paid off, and that balance sheet is gradually going to shrink. And so the question is that we're debating is, when do we start that shrinkage process, that natural roll-off? And what we've said publicly is we expect to start that by the end of the year. No final decision's been made, but that's where we're heading. And I think that's a good strategy. And so I feel like we're putting a lot of thought into how to shrink this back down to a more normal size, and I feel confident that we can do it without disrupting anything.
So I want to refer to the level of debt at all levels of government across the country, as well as unfunded commitments for retirement and that of government employees and various degrees of funding depending on which state you're in. And we're well aware of the fear-mongers that say there's bound to be a collapse of the financial system and the only solution is inflation and you better buy gold and all these other things. So can you just comment in general about the economy's ability to deal with the commitments that we've made at all levels of government and how you see that all working and playing out over the next few decades?
Sure. I'm glad you said over the next few decades. So first of all, this is an example of what is purely fiscal policy. So technically, we as the Federal Reserve, we have a deal with Congress where Congress has said, we won't get involved in your monetary policy, you don't get involved in our fiscal policy. And so we try to honor that. So I'll speak over the long term. Over the long term, there's no question that we do need to run budgets that the country can pay for. We cannot have deficits just expanding forever, because what will end up happening is investors who buy U.S. Treasury bonds today, investors in the dollar, so to speak, will end up saying, well, gee, Europe maybe looks healthier, or China looks healthier. Maybe they don't want to invest in the U.S. government because the U.S. government is just spending and spending and spending. This is a long-term challenge that we have to get our fiscal house in order. In the short term, the U.S. government bonds are very strong. The U.S. credit quality is very strong. No, I don't think anybody's stronger, frankly, in the world than the U.S. economy and how robust we are. But we do have very important long-term fiscal challenges. And these are really political decisions about how much as a country do we want to spend on healthcare, how much do we want to spend on retirement for our citizens and for our community members. These are fundamental questions that the American people have to ask and answer. But at the end of the day, we do have to live within our means. Every country has to live within our means. And right now, if you just do the forecasts of where the spending looks like it's going to go, it goes like a hockey stick, up and up and up. Now, that's not next year, and that's not in the next 5 years, but it is in the next several decades, so we will have to make tough choices as a country.
But you guys have an influence on inflation.
We do. We do have an influence on inflation, correct? I mean, our job, so the Fed's job, let's give an example. So let's say Congress did nothing, and they said, we're just going to spend the way the forecasts look like it's going to go. That would naturally be, we're spending more than the economy is producing. That would naturally lead to inflation. And if nothing changes on the fiscal side, that would mean the Fed would have to respond with higher interest rates to keep inflation in check. So that ends up being very costly to the economy. And so you're right, it could lead to unchecked spending, can lead to inflation, but that will then lead to higher interest rates. Just like some of you may remember in the late 70s and early 80s, we had very high interest rates to deal with very high inflation. We don't want to get there. So it's much better if the people, through their elected representatives, make some of these tough choices when times are better. Thank you.
I have a question about the Fed's policy of keeping interest rates, seemingly abnormally low for years and years. And of course, you answered it somewhat in that, you're helping boost the economy, people can buy houses and so forth. But what about the safety of senior savings? I haven't heard you address that yet. We have, I'm an old goat myself now, and we have to, we're forced to put our savings into a lot of equities and that sort of thing because there's no money in safe savings like CDs once were. And I don't know if we're getting into fiscal policy there or what it is, but what about that? I mean, on the one hand, we have an inflation problem where in the last 50 years, as an adult, our dollar has reduced in its buying power by about the factor of 6.8. So, a dollar now is only worth about 14.7 cents compared to was in 1969. So we have savings, and as time goes by, those sort of safe savings become more worthless every year. And I don't see the Fed's policies as doing us much good.
Well, I appreciate your comments, and I'll respectfully disagree, and I'll explain to you why. Because when the Fed screws up, everybody suffers. So the Fed screwed up royally, to be honest with you, in the 70s. And we saw very, very high inflation, double-digit inflation. And then there was a Fed chairman at the time named Paul Volcker who was appointed, and he said, you know what, I'm going to do what it takes to get inflation back in check. And over the last 30 or 40 years, what you've seen is inflation has gradually come down. And we feel like, no promises, we feel like we've got this under control and we can keep inflation very, very low for the very reason you just said. Because it hurts you, it hurts everybody if all of a sudden your buying power is being eroded with these high inflation. So I think the Fed has done a good job keeping inflation very low. But Congress has given us two mandates. One mandate is very low inflation, which we're achieving. The other mandate is maximum employment. And so that's why for the last 5 or 6 or 7 years, we've had very low interest rates. One is we have a target of 2% inflation, and I can explain why it's not zero in a moment. So number one is we want to hit that 2% target of inflation. And number two, we want to have as many Americans working as possible. And those two reasons, that's what's driven interest rates being as low as they have been. Now the reason, some people say, well, why have 2% inflation, right? Why not zero? It's a good question. The reason is this: if we ever tip into deflation, which is falling prices, it's devastating for all of us. Because if you have a mortgage, I have a mortgage, you have a mortgage, and now prices are falling, well, the size of your mortgage stays the same. What ends up happening is your equity gets wiped out. And now all of a sudden, your home, or your mortgage is worth more than your home is. So falling prices in an economy can be very costly, and it leads to a downward spiral. So we want to avoid deflation. And the danger is if you just go a little bit into the red, maybe you lose control and it takes a while off away from you. So most central banks around the world have said low and stable inflation with a little bit of margin for error, 2% is the right number. And we've actually been coming up a little bit low. We have not been able to hit our 2%. We've been hitting like 1.5, 1.75. And if we had 0 as our target and we came up a little bit low, we'd be in deflation and your debts would be getting bigger on a real basis as a result of that. And so I know it's a complicated answer, but I think over the last few decades, the Fed has done a really good job managing that inflation to protect your buying power, which is what you were asking about. Okay, follow up. Let him follow up. Can you send him the mic again?
Does it ever give you a little twinge that our money is, compared to, say, for example, the year I was born, 1948, is that dollar, is worth, that $1948 is worth 10 times. In other words, what it would take, $10 to buy the same thing that a dollar bought in 1948. So pretty soon,
Yeah.
I mean, you keep that trend going, pretty soon our dollar is worth exactly nothing. So are we going to be a country that has, a $1,000 bill reintroduced?
Right,
You know what I mean?
right.
Like,
I know what you mean. So here's why you should sleep well at night. Because if you do our comparison against other countries, this is a phenomenon of a market economy that all market economies experience, and we're doing really well. Let me just say something. Our economy, we have our struggles, and you probably know them as well or better than I do. But I would not trade places with any other country in the world, and there's no economy in the world that is more competitive than ours. Every other country has challenges too, and I would put us head-to-head against anybody else in the world, and I think we'll win. And so I hear what you're saying when you're comparing us against us over time and what's happened to the dollar. But if you compare our competitive position against other countries, we've done exceptionally well, and I believe we will continue to do exceptionally well. And currencies like the dollar is a pure relative measure. It's the dollar against the euro. It's the dollar against the pound. It's the dollar against any other currency. And you always have to think about that relative comparison. Sorry, long answer. Yes, sir. He's been...
Yes, I wanted to talk a little bit about why banks fail.
Sure.
And I noticed in reading some press clippings that you had talked about if banks had larger reserve requirements, they wouldn't fail as often. And I wanted to respectfully disagree. And my feeling is that the main reason banks fail relate to the management of the banks and relate to the bank's management of risk. And I think that when there were a lot of bank failures, it was due to the fact that the ratings on mortgages weren't set properly, the appraisals weren't done properly, and as a result, the banks were lured into the idea that they could make great returns on investments that weren't really good at all. And so I wanted you to defend your position that larger reserve requirements would take care of the problem.
Sure. Well, first of all, thanks for your question. And let me just be clear. I agree with you why banks fail. Banks fail because banks make bad decisions. And whether they were duped or they were stupid, I don't really care. We're all human, and we're all going to screw it up at some point. And the question is, who's on the hook when they screw it up? And so I agree with you. In the crisis, there were a bunch of mortgage-backed securities that were rated AAA that should never have been rated AAA. But the banks were also stupid on their own end for either issuing some of those mortgages or bundling them together or buying those mortgage-backed securities. My point is that, go back to the mortgage example. So when my wife and I bought our house around the Twin Cities 2 years ago, the bank made us put 20% down in our mortgage, in our house. The reason the bank makes me and you put 20% down is that 20% is designed to protect the bank in case you run into trouble. So that if you run into trouble, they'll sell your house, and there's that 20% cushion to make them whole on their loan to you and me. Well, if we make the biggest banks, the big ones, put down 20% on their investments, that 20% will protect you and me, the taxpayers, from when they screw up. Either they screw up because of fraud or stupidity or willful ignorance, I don't care. The question is right now, do the banks have enough of a down payment on their assets to protect you and me? And I say no, not even close. We need to double their equity requirements, and that's what will help protect us. Let the gentleman respond.
I just wanted to do a follow-up and mention that if you do let banks fail, what happens is the FDIC comes in and they sell off the deposit notes of that bank. They give them to another bank along with a huge premium for them to handle the deposits that went bad. They also get into a situation where they have auctions where they mortgage off real estate, and what they can end up doing is completely tank out the real estate market in an area, and then when they unload the properties in the tanked real estate market, they get almost nothing back for them. And as taxpayers, then we go in and replenish the FDIC, so that even if you say, well, let them fail, my feeling is whether we give them a bailout and give them a lot of money, or whether we let them fail and then we end up giving the FDIC a lot of money, I don't see a situation where we're going to end up not paying for it.
Well, but so here again, we're agreeing a lot more than you realize, because, and by the way, my comments are directed at the giant too big to fail banks that almost brought down the U.S. economy in 2008. I'm not talking about little community banks, which are not risky for the whole country, though they are important to the local community if they fail. But you know, the biggest analogy that I use, you pointed out I like to use analogies. A big giant bank, like a Wall Street $1 trillion bank, is like a nuclear reactor. If a nuclear reactor melts down, you understand that the government will spend whatever it takes to try to stabilize it. Not because we care about the power company, forget the power company. It's for all of our sake, because our communities will be devastated if that reactor melts down. That's why in 2008 we had to go in and stabilize the biggest banks, not for their sake, but so they didn't bring down the US economy. So given that, my question that I'm asking our experts is, how do we minimize the chance of that meltdown happening? As a country, we could decide to ban nuclear power. We haven't done that. Instead, we said we're going to regulate it so tightly. You can never eliminate the risk. You can never make it zero, but you can minimize the risk. And what I'm saying we need to do for the biggest banks in America is make them have that big down payment, so we've minimized the risk of failure so that the taxpayers are not on the hook. I think we want the same thing. Other questions?
So my question,
Yes, sir.
my question is getting back to one of your earlier comments. You talked about variability within the region. You mentioned, for example, the Twin Cities doing very well, other places not as well. And in fact, my non-academic observation is nationwide, cities tend to be doing well, rural areas not doing well, and perhaps worldwide. It's not only a discrepancy in wealth, but a discrepancy in opportunity for our children. Is there anything monetary policy can do to affect that discrepancy of opportunity?
Hard for me to see how monetary policy can affect that, because, as I said, it's such a blunt instrument, and we either raise interest rates for everybody or we cut interest rates for everybody. But that's actually the point of the research initiative that we've just kicked off, to look at, are there models that work, either in rural communities that have been successful in promoting economic development and closing those opportunity gaps. Education is enormously important, and making sure that kids across the country, across our region, all have access to a very high quality education is enormously important for the kids' sake, for the community's sake, for all of our sakes. It's enormously important. And so these are things that we're looking at. These transitions have happened over time. It's not easy. They've never been easy. They're not easy now. And as you think about automation, more automation coming into the U.S. economy, these transitions are continuing. Maybe they're accelerating. And so we have to keep our eyes open. I wish I had an easy answer for you. I don't. I do think education every year is just becoming more and more and more critical to our generation, to the next generation, to the next generation after that. And making sure kids, wherever they live, get access to that high quality education is paramount. But it's got to be more than just that, but I think that's a part of it. And I wish I had a better definitive answer for you. But we're aware of it, and we're paying attention and trying to work on it.
There's a question on the back, sir. Thank you.
Yes?
This venue that we're seated in tonight is very close to the geographic center of the traditional Ojibwe world, and we're about equidistant between two Ojibwe nations, Red Cliff and Bad River. Native communities, and I would say all communities in this part of the 9th District, are very interested in rural economic development. Are there specific tools that the Minneapolis Fed has that we can use in this part of the 9th District for economic development?
Well, part of it is, let me talk a little about our Center for Indian Country Development. So this is a center we launched a few years ago. Patrice Kunish, where's Patrice? Stand up and let people see you. Patrice leads our work on Indian country, everything from trying to tackle land issues so that somebody could start a business on reservations. How do people get mortgages on land there? There are huge legal issues that she and others at the Minneapolis Fed are trying to work through that could help bring economic development to those regions. Also education, some of the education issues that the Minneapolis Fed's been working on, such as early childhood education. They've done a lot of work on that at the bank. The state of Minnesota has adopted a lot of those ideas at the state level. Patrice and our team are working very hard to try to bring some of those ideas to tribal nations as well, early childhood education for their kids as well. So these are areas that are, I mean, the more I learn about it, the more complicated these issues are. I'm learning that. But Patrice and her team are at the forefront of trying to see what we can do to bring economic development, economic opportunity to all parts of the 9th District, including the tribal areas, which are enormously important in our region. And so I would ask you, sir, afterwards, maybe I could connect you to Patrice, and she can help give you some of the information that we're working on and get you plugged into those conversations.
I want to follow up on the question this gentleman over here asked or talked about bank failure. First of all, I want to thank you for coming to our northern Wisconsin area. Really appreciate that. And it's been interesting to read your comments over the past year and a half or so about your position on too big to fail and the capitalization of banks, which I agree with a lot of what you're saying. I also, if I understood correctly, you believe that the repeal of the Glass-Steagall Act by Congress in 1999 probably had a contributing factor to the housing recession of 2007 and 2008. Following up on that, do you feel that shadow banks should be under the federal requirements, the same as commercial banks are? And also, what do you think are the positives and negatives of the Dodd-Frank Act, which would address some of the things we're talking about in reference to banks?
Sure.
Do you want to explain what the shadow box is?
Yeah, so there's a lot, gentlemen, in the gentleman's question, there's a lot wrapped up in there. Let me try to unpack it. So first of all, after the Great Recession in 2008, 2009, in 2010, Congress passed what's called the Dodd-Frank Act, which is a regulatory reform act trying to prevent this type of crisis from happening again, trying to really address the too big to fail issue. So Dodd-Frank did some good. So the banks have more capital, that buffer that I talked about, than they had before the crisis, and the regulators have some more tools to try to deal with a bank that gets into trouble. But it didn't go far enough, in my opinion. The biggest banks are still too big to fail today, and in some ways it made the problem worse, because the Dodd-Frank Act, when it was really focused on the biggest banks, it actually covered just about everybody. And so it actually made the regulations tougher on little banks, and it put them at a competitive disadvantage to the big banks. So, if regulators come out with new rules, and a bank needs to hire another compliance officer to deal with those rules, it's very easy for $1 trillion bank with 100,000 employees to hire one more compliance officer. A local bank with 10 employees, that's very expensive for them to hire that one compliance officer. So in a weird way, Dodd-Frank made the too big to fail problem worse because it gave more economies of scale to the biggest banks. So it did some good, but it also did some harm. And so our plan at the Minneapolis Fed is to relax some of the regulations that are smothering the little banks that are not risky for the country and really focus on addressing the too big to fail issue, which are just the largest banks in America, the biggest dozen or so. And then Glass-Steagall. So the gentleman raised this law. It's called Glass-Steagall. Coming out of the Great Depression in the 1930s, Congress passed this law that separated investment banking from commercial banking. So investment banking is trading in the markets and issuing stocks and bonds, and commercial banking is making loans to businesses and to homes. So they separated them. In 1999, Congress said, no, we don't need to separate them anymore. Let's let them recombine. I actually don't think that simply cutting those two things apart will solve too big to fail. Because in 2008, we had pure play investment banks that were too big to fail, and we had pure play commercial banks that were too big to fail. It wasn't simply the combination of those two activities. So I've said I'm not opposed to separating them, but I don't want anyone to think that simply separating them will address too big to fail. All right, last part, shadow banks. So what are shadow banks? Shadow banks are things like hedge funds and even mutual funds. You know, you invest in your 401k and your 401k invests in a mutual fund. That's a different type of financial vehicle than a traditional bank. So the question is, these shadow banks have grown a lot over the last couple of decades. They might be risky themselves. So what we've said in our plan for the Minneapolis Fed is we want to tax the debt of shadow banks to prevent them from getting too big and becoming risky in their own right. And so what we try to do is we end up trying to treat big banks and shadow banks equally, so we deal with the risk wherever it is in the financial system. So I'm agreeing with the spirit of your question, and on our website at the minneapolisfed.org, I know this is very detailed, I'm sorry. On our website at minneapolisfed.org, there's a 10-page summary of our plan, and there's a 50-page detailed plan that walks through all of this in granular detail. You asked a very good but very complicated question. Yes. Oh,
I had a question.
hold on, there's a microphone for you.
You mentioned monetary policy is to keep inflation at a certain rate, but also what's a mechanism you use to affect unemployment?
Yep, so we don't directly affect unemployment, but what we try to do is use interest rates to achieve both of these two outcomes. So stable prices, so 2% inflation, and what Congress has called maximum employment. So imagine a scenario where inflation is very high and unemployment is very low. So a really hot economy. What we would do is we would raise interest rates to get inflation down, and that would probably cool off the economy, and that might lead to a little higher unemployment. Or you could have the opposite situation where you have a very cool economy where we will raise interest rates, which could get unemployment down and get economic growth back up. So these are the two.
Seesaw.
It's a seesaw. That's exactly right. So we're using interest rates to try to level off this seesaw. Now, sometimes you might get into a situation where you have high inflation and high unemployment, and then it's a tough situation. What do you do in that situation? But typically, you could think of it as a seesaw. Thanks for pointing that out. Yes, sir.
Well,
oh, ma'am, I'm sorry.
I
saw his hand up, and you had the microphone.
So going back to the Dodd-Frank question, I wanted to get your opinion in regard to the Consumer Financial Protection Bureau and the ongoing and current efforts to either eliminate it or shift the control of the purse strings to Congress rather than the Reserve. And let me know what your thoughts are on that.
Well, you're getting into what I would consider to be pure fiscal policy, which is how Congress decides to pay for something. Right now, the Dodd-Frank Act created this new Consumer Protection Bureau called the CFPB, Consumer Financial Protection Bureau. And right now, the budget for it is what's considered to be, it's not appropriated, meaning it just comes from the Federal Reserve's earnings. It's not a decision Congress makes every year to say how much they want to fund it. And they did that by design, but not everybody in Congress is happy about that. And they want, some in Congress want more control over how much the CFPB spends and what they spend it on. And so I will defer to you and to your colleagues in the Congress to decide which is appropriate. And so I think reasonable people can have different positions on the funding for the CFPB.
I guess I was looking for how you think that might impact the operating of that organization.
Well, I mean, I think congressional oversight is appropriate, right? And it's up to Congress to decide. I mean, honestly, I think that most agencies of government are appropriated by Congress, and most agencies of government are able to do their jobs, and there are budget battles, et cetera. So I don't think the notion that just because something's appropriated by Congress, therefore they can't do their jobs. I don't think that's true. I mean, the history of our country doesn't suggest that that's true. But I also understand why some people want to have it as a separate carve-out. And so to me, this is a very reasonable discussion for Congress to have, And I think reasonable people can look at that and have different positions on that issue.
So there's a question here.
Yes, sir.
Is this on?
There you go.
There. Okay. You've touched on this a bit already, but I wonder if you could go a little bit deeper. The connection between early childhood development, workforce development, and economic development. I read a little bit about the Strong Foundations conference that you had back in March. So I wonder if you could expand on that a bit, and what does that mean for us in rural Wisconsin?
Sure. Well, when you look at, we talked earlier, the gentleman asked me about the unemployment rate. And if you look beneath the surface, different outcomes for different populations. A huge determinant of economic success as individuals is the quality of the education that we get. Somebody who gets a good education is much less likely to be unemployed, is much more likely to find a good job and be able to keep that job. And if you trace that, it really does start early. Mm-hmm. And our research at the Minneapolis Fed shows that early childhood education, I mean, even, it's amazing, and the more I read about this, I mean, you literally can trace it back to the first, like just after birth, it becomes very important. The kind of interaction they have with their parents and with families and whether they're being read to, et cetera, all of these things end up being very important for brain development and then for their ability to learn and then their success in the earliest part of education and then onward in life. So if you trace this back, the earliest education ends up being enormously important for that individual, for that family, for that community, and then for the Federal Reserve in terms of the maximum employment we can achieve as a nation. Right? We're limited. If we have a population of people who are less educated, then when we declare victory, maximum employment, it's going to be a less good outcome than if we have a population, a country of people who are well educated. And so I think it absolutely is relevant to our maximum employment mandate. And our research and others' research has shown that early childhood education is enormously important to achieving the kind of outcomes that we all want. Question in the middle. Yes, sir.
I'm wondering what kind of modeling you do for potential changes in the economy. The single-payer health may have some, changes, affect some changes in the economy, moving away from a fossil-based fuel system will have some changes. Do you model those particular things, and what do you find?
We do. We run a lot of models, and so a lot of what you're asking about is fiscal policy, and I'll give you an example. So after the election in November, you saw the stock market rally, and there was a lot of optimism in the markets that maybe regulatory reforms were going to come, maybe tax cuts or tax reforms were going to come, and that would boost the U.S. economy. Well, personally, as one member, one principal in the FOMC, I didn't adjust my forecast because of that optimism. Because I said, I have no idea what Congress is going to pass. I have no idea what will actually become law. So I don't have enough information to make any forecast changes. Let's wait and see what Congress actually passes and what the president signs into law. So when we look at things like potential healthcare changes, we will model it and see this is what we think is likely to happen. And if it happens, is it going to have a macroeconomic effect or not? And I haven't seen any estimates of likely changes to healthcare that will yet show up in our macroeconomic models, though healthcare is enormously important to all of us, don't get me wrong. We look for those changes that we think are going to have a big impact on economic growth, on where productivity is growing, on employment, et cetera. And I don't think we have enough information yet to make any forecasts about what Congress is going to do and what changes could happen. But I'll give you an example. If Congress passed a huge tax cut that was all financed by increasing the deficit, that would likely have macroeconomic implications that we would have to incorporate into our models. If Congress otherwise said, no, we're going to raise some taxes here and cut other taxes here, that probably is not going to have a big macroeconomic effect. It'll probably have more distributional effects, which we have less ability to influence with monetary policy. So we do model these things, but we try to figure out what's going to move the macroeconomy, because that's what we have to focus on. In the energy area, we do pay attention to it as well, but one area that we do look at is we do scenarios of different economic shocks. So I'll give you an example. When oil prices fell from $100 to 26, that's what economists would call a very positive economic shock. All of a sudden it's a boost for the US economy, and we can model what we think that'll do to consumer spending. Obviously, that hurts the energy sector, but it's good for consumers. It's good for you when you're filling up your tank and driving to work. We will forecast that through. To the extent that we have an energy industry that's more diversified, then, so let's say solar, let's say wind, let's say other natural sources, if it's more diversified, you could think of it being more resilient and less vulnerable to any one sector having either a big oil price swing up or swing down. So we do pay attention to it, but I wouldn't say that solar and wind yet are moving the overall macro economy yet. Last question. Okay, good questions today. Thank you for speaking up. Yes, sir.
Thank you very much for joining us today. Our region, Bayfield and Ashland counties, we're a rural community. We have a very stable population, not increasing a lot, not decreasing a lot. We also have a growing senior population. I think actually Bayfield and Ashland counties have some of the most rapidly progressing number of seniors percentage-wise in the state of Wisconsin. I know you provide your work area is on a national and a regional scale, but I was wondering if you could provide any free advice for our local communities on strategies, opportunities that rural communities like ours in a cooler climate might explore.
Or you might be warming.
Yeah,
that's great. Yeah, I'll tell you this, my only disappointment in coming to Minnesota is how lame the winters have been. I've been here for 2 winters, and it's like, what's this vaunted Minnesota winter? I haven't experienced it yet. I know I'm asking for trouble. So this is something communities all across our region are struggling with. And I would say the ones that nobody's figured it out perfectly, the ones that I've seen seem to be more optimistic, they have a very good partnership with the local civic leaders, the local business leaders. They put together a strategy of trying to attract economic development to their region, to try to improve the quality of life so that young people who grow up there, maybe they go off to college and then they choose to come back, to try to bring some amenities so people feel like, hey, yeah, this is a place where I want to raise my family and return to. And so I wish I had a better answer for you than that, but I do see many communities facing the same struggles, and some are better than others at getting everybody marshaled around the challenge and saying, hey, let's come up with a strategy. Let's make this place an attractive place for young people to want to return to, have their families here. Let's try to attract people to come here for vacations. Let's try to attract businesses to come here and make this a business-friendly environment. And I'd say they seem to be having some success when they do that. But it's not easy, and I know it's not easy. And so I'll keep my eyes open. Well, thank you. I really appreciate it. These are great questions, great dialogue.